Well, 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 well. What do we have here? It's a Fed research paper from June of this year admitting that QE, quantitative easing, increased bank deposits during the pandemic because the Federal Reserve was buying assets from non-banks, which is exactly what this channel and only this channel has been telling you for the last 20 months. Welcome to Best Evidence. My name is John Titus, and in this episode we are going to review the mechanics of pandemic QE as explained by this channel multiple times and now is officially ratified by the Federal Reserve itself. Briefly put, QE during the pandemic increased bank deposits contrary to what countless professional financial gurus told you. So after we review the correct understanding of pandemic QE, we will look at the implications of the Fed causing bank deposits to increase, because it reveals a lot about the Fed as it now lobbies for ever more control of the monetary system through CBDC. I try to make videos that are self-contained, and this video will be no exception. So I want to walk through at least one feature of the monetary system that is essential to know but not widely understood. If you don't understand it, you are not going to understand why QE didn't cause inflation after the global financial crisis, but caused huge inflation starting with the pandemic. And here is that critical feature. When it comes to digital money, I put money in quotes because it's not really money, but in the street sense, we think of these things as money. There are two types of accounts in two different tiers of the monetary system. In the top wholesale tier, the Fed credits reserve accounts held by banks. Okay, so that's one tier. To those banks, those reserves in their accounts are money, and the Fed creates that money out of thin air. You are not in that tier. I am not in that tier. You don't have an account at the Fed, neither do I. We can't use reserves. They are no bueno to us. In the second lower tier, that's where we are, banks credit our deposits accounts and then credit the deposit accounts held by any non-bank. So your account, my account, business accounts, even financial companies that aren't banks, they are in that second lower retail non-bank tier. To non-banks like you and me, those deposits are money which banks create out of thin air. In the global financial crisis, there was no second tier when it came to QE. QE back then was a bailout of banks. It was a very simple deal, really. Banks had worthless assets. The Fed came in and it created money out of thin air, and it bought those assets at face value, and it credited the bank's reserve accounts with money. It was a simple asset swap. You have a worthless mortgage-backed security on your balance sheet, Citigroup? No problem. You give us, the Fed, the asset, and we'll replace it with huge deposits in your reserve accounts that you hold with us. That is not what happened during the pandemic. In the pandemic, the Fed bought assets not from banks in that first tier, but from non-banks in the second tier. And that is why, in a nutshell, bank deposits increased during the pandemic version of QE, but did not increase during the global financial crisis version of QE. They are two different animals. Bank deposits increased because asset seller during the pandemic was non-banks, which used bank deposits, not reserves. Pandemic QE is more complicated because it involves two tiers of the monetary system, not just one tier. And new money got created during the pandemic on both the wholesale and the retail level, in the latter of which, the retail level, the creation of money there is what has caused inflation. That simply was not a factor in the wake of the global financial crisis. I have made 3 videos on this. Actually, I made 3 videos on this before that Fed research paper came out, and then I made a 4th video about this issue after the paper came out, but before I actually knew about it. In the first video, I walked through how the Federal Reserve, which can't create bank deposits, ends up buying assets from a non-bank anyway, which needs to be paid in deposits. So the mystery there is, well, if the Fed can't create bank deposits, how is it going to buy an asset from someone who needs bank deposits as money? How does that work? And so the way it works is the Fed goes to the seller's bank, the asset seller's bank, and says, I want to buy an asset from your customer, so you, bank, need to get in the middle of that transaction so I can make this happen. That first video is called Quantitative Easing is the Biggest Sham Ever. It came out December 17th, 2020. And in this one, I did an extensive visual demonstration of how the Fed pulled that transaction off. I used red marbles for bank deposits and white marbles to show reserves, to explain how the Fed, which can only pay with white marbles, can buy an asset from someone like you or me who can only accept red marbles as payment. Here is a short clip from that video explaining how that mismatch between the two tiers gets resolved. Non-bank financial company has an asset it wants to dump, like the U.S. Treasury. It's not going to get a good price. In rises the Fed. The Fed creates $500 million of reserves out of thin air. Problem is, non-bank financial company doesn't have an account at the Fed, can't use the reserves, so the Fed orders the intervening commercial bank at which the non-bank financial company banks to create $500 million of bank money out of thin air, and now the transaction can take place. The $500 million treasury goes to the Fed, and the $500 million bank money now gets into the stock market. So the key takeaway there is that new bank deposits, red marbles, are created by banks along with, and to the same extent as, new reserves, white marbles, that are created at the same time by the Fed. By the way, if you don't understand the difference between reserves created by the Fed and bank money created by banks, go to the 16-minute and 30-second mark of Wherefore Art Thou Reserves, and I walk through a visual demonstration there, really explaining why two tiers exist in the monetary system to begin with. It's rooted in the fact that it's not really money in our system, it's really a debt-based system, and that's what necessitates two tiers of the banking system. Likewise, if you don't understand that banks create new money out of thin air, bank deposits, that they're simply created out of thin air, just like the Fed creates reserves out of thin air, I have another video called Mommy, Where Does Money Come From? That walks through that process. You can see it there. And finally, if you don't really understand the two-tier monetary system, like why are there two tiers of deposits on one tier and reserves on another tier, go to the 4-minute mark of a video I did fairly recently called Meet the Fed's New BFF, and I walked through the two-tier system in basically 20 minutes. The upshot here, though, is that quantitative easing, where the asset seller is a bank, as it was during the global financial crisis, is night and day different from quantitative easing where the seller is a non-bank. When the seller is a non-bank, new bank deposits get created in parallel with new reserve creation. When the seller is a bank, by contrast, new reserves are created, but not new bank deposits, because new bank deposits simply are not needed to pull that transaction off. The second video I did in this series about pandemic quantitative easing explains that it was BlackRock who told the Fed that its old global financial crisis version of QE, where it was buying assets from banks, wasn't going to work when the next crisis hit, and that it needed to convert reserves, needed to find a way to convert bank reserves into deposit money, basically. BlackRock said to the Fed, you need to find a way to get reserves into the hands of non-banks, and it said this just 4 months before the pandemic rolled out. How about that? This video was called Larry and Carson's Excellent Pandemic. It came out on August 14th, 2021. And the video, as I say, walks through BlackRock's plan, which the Fed executed to perfection. How do we know that it was executed to perfection? Because new bank reserves from the Fed ended up getting matched dollar for dollar by new deposits in bank accounts. That was the tell that the Fed was buying assets from non-banks during the pandemic. The third and final video I did, at least the last one before the recent Fed paper came out, was called Meet the Fed's New BFF. That came out November 24th of last year, 2021. And this video really connects the dots between the pandemic version of QE on the one hand to the problem of runaway debt in the U.S. on the other hand. Runaway meaning basically the interest payment on the debt, the non-negotiable payment on the debt is now bigger than tax revenues. As I mentioned earlier, if you skip to the first 4 minutes of this video, you get a quick primer on the two-tiered monetary system and the two very different versions of QE. Anyway, after that third video, I really felt all I'd done to really explain how quantitative easing during the pandemic was driving bank deposits and the stock market up. And yet it seemed like, and it still seems like to this day, that every time I watched a financial guru talk about quantitative easing, they'd act like pandemic QE was exactly the same as global financial crisis QE, when they were totally two different things. You know, the pundits would say, oh, reserves don't leak out, it's just an asset swap, it's not inflationary. And no matter how high the graphs of bank deposits were going, they were rocketing through the ceiling. This chorus of Gomer Pyle economists continued to parrot their pet phrases as if quantitative easing in the pandemic was just like the old quantitative easing. Reserves don't leak out, it's just an asset swap, QE is not inflationary, reserves are just tokens, it's balance sheet neutral, and all these nonsense phrases. And it was like, do you actually look at numbers in your profession? And I'm thinking to myself, is this going on right now? And at the end it was like, oh, well, I'm just a YouTube leper. I accept that. Who cares if the reality of pandemic quantitative easing is drowned out by this chorus of charlatans? And so you can imagine my astonishment when I found the Federal Reserve research note explaining that bank deposits increased during the pandemic because the Fed had bought assets from non-banks. Here is the paper. As you can see, it is dated June 3rd, 2022. I'm going to zoom in on that real quick. And it is titled, Understanding Bank Deposit Growth During the COVID-19 Pandemic. And you can see here in this first figure, total bank deposits of U.S. commercial banks. And that's really the central point of this paper, is like what happened here. And you can see the graph they've got here. They're really wondering what happened here with this spike in bank deposits. Zoom in a little bit. And so what you can see is that this trend line here of bank deposits, it's totally out of whack during the pandemic. This is the pandemic here. This is the global financial crisis here. Anyway, that's what the paper is really getting at, is what caused that spike in bank deposits. Now, remember from the clip I showed you earlier, from quantitative easing is the biggest sham ever, new bank deposits get created whenever the Fed buys assets from non-banks. So now what we want to do is we want to see what this Fed paper says on that issue, like where is that spike coming from? And you can see, we're just going to have to scroll down here, and here we go. Yeah, here it is. This is the section we want to talk about, the roles of credit line draws and the Federal Reserve's asset purchases. It's really the asset purchases that are driving the increase. Let's zoom in. Here we go. The asset purchases by the Federal Reserve led to the creation of reserves in the banking system. That part of the sentence doesn't really tell us that much, because the Fed always creates new reserves when it buys assets. Regardless of whether it's buying from a bank or a non-bank, the Fed is creating reserves. That's just how it is done. That's how asset purchases are made, regardless of the source of those assets that the Fed's buying. But the sentence goes on to tell us what happens when those new reserves buy an asset from a non-bank. Specifically, it tells us, to the extent that the Federal Reserve purchased the assets from non-bank entities, they also led to the creation of deposits. And there you have it. You've got buying from a non-bank entity gives you newly created deposits. So the Fed is telling you exactly what I told you in these three videos. But just to firm up the point, let's scroll on down to see exactly how that takes place, because the Fed explains this in the appendix of the paper. And so let's look at how the Fed describes the mechanics of an asset purchase from a non-bank. And here we go. When the Federal Reserve purchases securities from a non-bank seller, so that's the exact scenario I've been talking about in these videos, it creates new bank deposits. And there you go. I want to pause it right there because these are very key words here. The Fed is actually going a step further than I've gone. I've been saying the Fed causes new bank deposits to be created when it buys assets from non-banks. The Fed paper right here, you can see it, comes right out and says it, meaning the Fed purchases of assets from a non-bank, it creates new bank deposits. That's very, very direct language there by the Fed. Remember those 5 words, because they're really the most important 5 words the Fed's written since 2008. And those 5 words, by the way, annihilate every one of the Gomer Pyle gurus telling you, oh no, QE can't get into the banking system. Yes, it can. The Fed says so right here. Feast your lying eyes on this quote there, Goober. It creates new bank deposits. That means the Fed buying assets from non-banks. So don't tell me it doesn't affect bank deposits, because the Fed says, the Fed disagrees, and it agrees with me, Best Evidence, saying, yep, it creates bank deposits. But let's go on. Let's see exactly how the Fed creates bank deposits. And the way it works is creates deposits by crediting the reserve account of the depository institution at which the non-bank seller has an account. Okay, so the depository institution means the Fed is crediting the reserve account of the bank at which the non-bank seller has an account. That's how it works. I've explained this multiple times in these videos. Let's continue. And then the depository institution, the bank, credits the deposit account of the non-bank seller. So the bank has these new reserves that came from the Federal Reserve as the buyer on the asset side, and now it is counterbalancing those reserves by issuing new bank deposits on the liability side of the bank's balance sheet. And that's what I've been telling you since December of 2020 in these videos. And now, 18 months later, the Federal Reserve says, you know what, that YouTube leper, Best Evidence was right all along. You know, really, if you think about it, that's YouTube for you, where the truth is treated like leprosy. But you may be saying to yourself, well, okay, so what? Bank deposits increased during the pandemic, big deal. Why should I care about that? You should care about that because of where those additional deposits showed up. It reveals a lot about the Fed's true remit, its true purpose. You might think that when the Fed bought those assets from non-banks, it was from non-bank financial institutions like BlackRock. And that's where the $4 trillion in new deposits is sitting. In other words, it would be sitting, you might think, in institutional bank accounts. And that's true to a very significant degree. And that's why the stock market went up. Those institutional investors, you know, they dumped their treasuries, dumped their mortgage-backed securities. They turned around and put it into stock market and put it into SPACs. But a huge chunk of money, a huge chunk of those deposits went into individual deposit accounts. And that's what you need to understand. It may be tempting to think that new bank deposits are sitting with the bottom 50% or really the bottom 90% of individual accounts due to the federal government's pandemic stimulus programs. But that's actually not the case at all, as we're about to see. And I want to start here by looking at a graph from the Fed's Fred website. As some of my readers, my viewers have told me, it's Federal Reserve Economic Data is what that stands for. I want to look at this graph of deposit accounts, and I'm going to blow it up here in a minute, but you can see here the title. I want you to look at the title, Deposits of All Commercial Bank Accounts. I'm going to blow this up. The title gets a lot smaller. I want you to notice that, because the rest of the graphs, they're going to be bigger, but the title is going to be really small. So you got to look up here for the title. So this is the graph you just saw of deposits at all commercial banks. And this graph goes back to July of '89. I'll explain that in a minute. And it goes forward all the way to just January of 2022. I will explain why that's the cutoff date in a minute as well. But I want you to notice that between January, which was right before the pandemic, we had $13.27 trillion sitting in commercial bank accounts and deposit accounts. And that rose up to really $18.0 trillion in January of 2022, just 2 years later. So that was a gain of $4.7 trillion. And I can tell you, if you look at this trend line here, that trend line, that's really loans is doing that. And so of that $4.7 trillion gain, I can just work out the math. $4 trillion of that comes from quantitative easing, and $0.7 trillion of that comes from the loan. That comes from loans that the banks makes. That's evident from other graphs, but I'm not going to get into that. Let's just look at the effect, though, of pandemic QE on checking accounts in different households according to where they are in wealth percentiles. And I want to start with the bottom. It's divided in, I would tell you quartiles, but it's not really quartiles. It's a Kentucky Fried Chicken. It's divided up funny. The first of the four segments it looks at, these graphs, the bottom 50%. And if you look at how the bottom, this is checkable accounts. This is checkable deposits and currency held by the bottom 50% of households in the U.S. by wealth. And really, this you can think of this graph, and the graphs I'm showing you is checkable deposits, because that $4 trillion increase of that, the currency increase was really about $200 billion. So you can sort of cast that aside and just look at and consider this graph a graph of checkable deposits. And if you look here at the bottom 50th percentile, the bottom 50%, you can see that the checkable accounts, the bottom 50% of the population had a total of $109.2 billion in their checkable accounts before the pandemic, and then after QE, they had $276.4 trillion. That's a gain of $167.2 billion. Now, if we go to the next band of wealth, this is the 50th to the 90th percentile. And really, again, this is checkable deposits. There's a little bit of cash there, but that's not much. And the numbers here are, before the pandemic, you had $393 billion. And then after the pandemic, you had those checkable deposits were $1177.6 billion. So a little bit over $1 trillion. That's a gain of $784.5 billion. Continuing on to the 90th to 99th percentile. This is the top. It's not the top 10%. It's the bottom 9% of the top 10%. Their checkable deposits went from $406 trillion up to $1,502.8 trillion, a gain of $1,096.8 billion. That's over $1 trillion gain there. And now finally, let's look at the top 1%. This is the 99th to 100th wealth percentile. Their checkable deposits before the pandemic were sitting at $220.2 billion. And then after the Fed, well, really by January of 2022, their checkable deposits in the top 1% were $1,331 billion, a gain of $1,110.8 billion. So the top 1% of the households, in other words, got 35% of the new deposits from quantitative easing. It was very, very skewed. Now, it is very easy. We know, you can look this up, there are 123.6 million households in the U.S. So if we go back, we can figure out how much the average household in each wealth band got from quantitative easing by the Fed during the pandemic. And for the bottom 50, I'll just run through the numbers here. The 123.6 million households means that the bottom 50% by definition has 61.8 million households. And so if you divide this out, remember the gain was $167.2 billion divided by 61.8 million households gives you $2,700 of extra deposit money sitting in the average household account for the bottom 50%. And if we just go through the other numbers, I'll just quickly run through them. The 50th to 90th percentile, their average household there got $15,900 in extra deposits from quantitative easing thanks to the Fed. The top 9% from 90 to 99, the average household there saw an extra $98,600 from the Fed's QE program during the pandemic. And finally, the top 1%, their average household saw an extra $898,700 in their checking accounts as a result of the Fed's quantitative easing during the pandemic. But these are staggering numbers that you're looking at here of extra checking account money in household accounts. These are household numbers, keep in mind, and they're staggering. So you might naturally be asking yourself, why did the Fed do this again? Well, let's just go to the Fed's website when the pandemic got rolled out to see what the Fed said in its own words. And here you can see the Fed announces extensive new measures to support the economy. This is a press release from March 23rd, 2020. And let's just see what the Fed said about what it was doing. Supposedly, this was done, the Fed rolled out all these quantitative easing. It was to support households, businesses, and the U.S. economy. Okay, well, they left out the part about helping the top 1%, but okay. It's funny because during the global financial crisis, the Fed said, well, we can't help underwater homeowners, and really our programs now are just helping banks and financial institutions, and the Fed saved those banks. The Fed saved those banks from bankruptcy. It gave them trillions of dollars of money in quantitative easing. And then those banks, if you recall, turned around and fabricated false evidence to foreclose on those homeowners. It ginned up fake evidence and went into the court. It perpetrated fraud on the court, these banks did. You might remember Linda Green, that name from a 60 Minutes episode. It was from April of 2011. People's homes were stolen because those bailed out banks. Those banks got bailed out by the Fed. Those bailed out banks ginned up fake evidence, and they stole people's homes. And it was no problem for the Fed to help those criminal banks. And that entire time, the Fed was saying, oh no, can't help individuals, can't help individual homeowners. They're on their own. And now in the wake of the pandemic, we learned the truth. It is possible for the Fed to directly help households. You just saw the graphs. The help is not limited to just banks and financial institutions. In other words, those people's homes were stolen because the Federal Reserve decided not to help them, and it lied and said, oh no, we can only help banks. The reality is the Fed could help individuals. It could have helped them all along. It could have helped them anytime it wanted to. The Fed simply elected not to do so back in the global financial crisis for people whose homes were being stolen by the Fed's owners, the banks. Remember, the banks owned the Fed. So the Fed bailed out its owners and said, oh no, it can't help homeowners. And now you're starting to see the reality. The Fed can bail out whoever it wants to. At this point, even if you can't see the Fed as the instrumentality of rich criminals that it is, you at least have to be asking yourself whether it's really a good idea to let the Fed control, via central bank digital currency, the financial lives of the same people it helped banks rob in order to enrich the Fed's owners. And that's just the starters. That's just an opening salvo in the way of questions. I'm going to come back to this paper. The privately owned Federal Reserve has no business running the monetary system, and it is privately owned. If you doubt me, I have another video called The Fed Kicking People When They're Down. Proves it in the Fed's own words. The Fed's privately owned, and you can see right here what it's been doing. But that's it for this video. I want to get back to murder of a rebel nation and get busy on that again. But happy Labor Day, everyone. Thank you so much for watching, and I will see you next time.